Hello, everyone. Yes, Chris Martinson of Peak Financial Investing with another episode here of Finance University. And today, very pleased to have Lawrence Lepard here of Equity Management Associates out of Boston. He's been to my farm once. Lawrence is a great guy, gold and silver investor, believes in Bitcoin, has his pulse really on all things financial in the markets out there. So we're going to have a really good rocking conversation today at a critical time because of all the popping and creaking sounds going on out there. Lawrence,
Yeah.
so good to
Hey,
see you
Chris,
again.
thanks for having me back. It's always fun to chat with you. I love your thread. I love your point of view. So this should be fun.
Good. Hey, for the people who don't know you, just quickly, what's your background?
Very quickly, I've been a fund manager my whole life, investment management. Until 2008, I was focused on technology, hardware, software, computers, internet, did pretty well with all that. Kind of retired in '08, or retired actually in '04, messed around for a few years. And then in '08, the GFC hit. And I thought to myself, you know what? I got radicalized for sound money. I could see what they were doing. I could see that the Fed was going to print away the value of the dollar, and so I pivoted and I got into the gold and gold stock picking business because I envisioned that we would have a decade that looked like the '70s with a lot of inflation, and in the '70s, gold and gold stocks and oil stocks were the two things to invest in. So I was a little bit early in '08. It's taken a little while to play out, but I haven't changed my view that we have the world has become inflationary. We reached peak deflation, in my opinion, in March of 2020. And we now live in an inflationary world. And I think the average investor is not thinking that through.
I agree. So, quick summary. Tough times ahead, you think?
I do. I do. I think that we are going to have more inflation. I can see that the rivets are popping, as I like to say, and you and I were discussing before the show. I mean,
Mhm.
we've got trouble in the financial system, and it's really quite simple, Chris. I mean, the problem is that you cannot expand the debt more rapidly than you expand the GDP. The
Thank you.
GDP is what pays the interest on the debt. And if you're using debt to grow GDP and the GDP doesn't grow fast enough, eventually the gap gets too large. The only way to solve that is to print money massively. They did it in '08. They did it in 2020. They're trying to stop doing it now. They've kind of got the brakes on for a little while here, but they're going to be forced to do it again. And there's a great chart on this in my quarterly report by Lynn Alden, which we can link the quarterly report to the show and you can see it. But it's just a matter of time until, as I like to say, printer is coming.
Well, if you, Lawrence, if you want to pull it up at any time, I'll just put on screen sharing here. No big deal. If you,
Yeah, give me a moment. It'll take me a minute here to find it,
sure,
but
sure, sure. So, yes, you say it's only a matter of time before they print, but of course, printing creates inflation, which is just broadly distributed theft, right? So the
correct.
way I'm looking at this right now is when you have that situation where since the 70s, since 1971, maybe since August 15th, we've been doing this crazy thing where we've been expanding our debts at twice the rate compounded that our underlying income or GDP has been growing. Blah, blah, blah. This is the only one question all investors, all individuals need to resolve. Who's going to eat the losses? Now, the
Yes,
bankers want to be sure it's not them, and they've been busy writing laws and working with their in the pocket representatives and Congress critters to write laws that they think will shield them from having to take all the losses. The government doesn't know what it's doing anymore, just deeply incompetent. I'm surprised. I mean, here's my sense of the government can be fractalized down to the city council of San Francisco raising the shoplifting limit and then getting more shoplifting and being confused by the outcome. Uh,
correct.
that's where I think we're at. So again, who's going to eat the losses? I think there are ways to avoid this, but you have to understand hard money. You have to understand that currency is not actually real money. You have to understand what real wealth is.
That's correct. I mean, at the end of the day, energy is really money, and goods and services are really money. I mean, money is a proxy for the things you want. Money is useful because it can buy you food, it can buy you healthcare, it can buy you things that you need. Chris, if you actually
Thank you.
go to allow me to do the screen share, I'm able to locate that chart now, and we can show it.
It's been
Let
turned
me,
on, so go for it.
I'm looking for the screen share. I don't see on the recording that I've
The
got here.
little green, it's the green one in the center there.
I've got whiteboards, apps, notes, more, leave. I don't have. It's funny. I don't have screen shares. Oh, no.
It
Stop
it
video
might be in
view.
the it might be in the ellipse. It might have gotten pushed off, but it's a
I'm
green. It
I'm
should say
I'm
screen
widening
share.
this up to see even more, so I'm trying to see it. This is two old guys messing around with technology that they don't understand. Oh,
All
there it
right,
is. Share screen. I found it. Okay, thank
there
you
it
very
is.
much. Here we
Fantastic.
go. And
All right,
can you see that? Is that
I sure can. I sure can.
so what you got here that I think is interesting is the blue line is the total debt in the society today in the US, and this is US dollars and US society. And the orange line is base money. And what you can kind of see is that, in the 71, we were on the gold standard, so everything was kind of squared away. And then slowly but surely, we've grown that debt. And whenever the blue line gets too far away from the orange line, things break. And the first example of them breaking, you can see with my cursor here, is in '08. Obviously, things broke, and
Mm-hmm.
we had to expand the base money massively. And then, of course, we tried to tighten and correct things, and we brought the base money back down into the 2015, 16, 17 timeframe. But then, of course, we had the repo blowout, and then COVID, and then things broke again, and we expanded massively again. And
Mm-hmm.
of course, as you can see, the blue line, the slope of the blue line is not slowing down. In fact, it's accelerating,
Mm-hmm.
arguably. And it's just a matter of time. I mean, unless they want to have the entire economy crater in and have basically all of the banks fail. We can talk about that in a minute because there's some signs that that's what's next to happen, given what happened in March with Silicon Valley Bank. They are going to have to expand the base money again. So this is why those of us in the hard money camp say, there aren't many things that are certain in the investment world, but one of the things that's extremely highly probable is that the government will have to debase the currency. And you asked the question earlier, who's going to pay? Well, my bet is that who is going to pay are the people who have dollars or savings in dollar terms, bondholders and cash holders. They'll still have those same bonds. They'll still have that cash. The bonds will be money good, but guess what? They won't buy as much. Their purchasing power will be debased and debased severely. And, as you and I recall, we're similar ages. When I was a high school teenager, I could buy gasoline for 25 cents a gallon. Now it's 4 or 5 in California, it's 7. And 5 years from now, it'll probably be 11 or 12 in California and 8 or 9 in Massachusetts. So,
Mm-hmm.
it just this debasement continually is pushing inflation and prices up. And I'm not allowed to give investment advice, so this is not investment advice. But I will say, just as a general rule, personally, what I try to do with my capital is find investments that protect it from this debasement. And silver and
Yeah.
gold mining stocks are kind of my first choice. So
Yeah. Yeah. So what I love about this chart, and for everybody watching right now, and for people who are just listening, because I know some of you just listen, we're looking at a chart here. It's got two lines on it. One's on the left-hand scale, one's on the right-hand scale. The left-hand scale is total debt. You've heard me talk about this before. Wonkishly, it's TCMDO in the Fed series. This is total credit market debt. It's all debt. State, federal, local, muni, corporate, all that. It's not unfunded liabilities. Okay. That's a whole different subject, right? Let's, yeah, right. Yeah.
That's
Lawrence
even
is laughing
worse.
away. Exactly. But, the debt is now well over 90 trillion. That's what the left axis is. That's what 90,000 billion represents on that axis. So over 90 trillion. The right axis is showing base money supply. So that's hanging out, I'm going to guess, 5.5 trillion. So there's a big gap between those two, obviously, because they're on very different scales. But when people say, oh, the US debt's at 120% of GDP, what they're talking about is official public debt. They're not talking about total debt indebtedness of the country, which is hanging out at close to 400% of GDP,
Right.
which is the total debt of the nation. So yes, we have to. I like to keep that in frame. And by the way, Lawrence, one of the things that drives me nuts is that we present GDP without backing out the debt, because
Yeah.
that's just a fiction, right? So let's say you're an economy and I'm an economy. You're on island A, I'm on island B. You're earning 100,000, I'm earning 100,000. Somebody takes a snapshot and says 100,000. They have two GDPs, they're equivalent. You're careful, and in fact, you save your money, and so nothing happens to you. You have 0% GDP growth. Bad boy, right? But I went on a spree, leveraged up my island, bought a boat, had a party,
Yeah.
and spent 100 grand on consumption using debt. And they would take that same snapshot and say, Lawrence grew his 0%. Boo. Chris grew his by 100%. Yay.
Right.
Obviously, it's
Right.
dumb when you put it that way, but that's exactly the situation we're in. And the U.S. government is deficit spending what, 6-7% of GDP, right? It's just
Eight,
completely
close to eight, and that's with a
unsafe.
healthy economy, and we've never done
Oh,
that before. I mean, to have this large a deficit, other than in World War II, which was kind of an exceptional case,
yeah.
to have this large a deficit with the economy at this level of full employment, it's unheard of. And what I would say that I think is important for people to understand is that the U.S. is the world's reserve currency and the biggest country, and therefore we've enjoyed a number of advantages. We're able to export our inflation and other things.
Mhm.
But I would say that it's important to understand that we are starting to look and behave like a third world country. In a lot of ways. I mean, in terms of government malfunction, all the things that have broken and gone wrong that you point to so clearly on your thread and in your show. And the financial side, it's very clear. And a lot of people, I think, are wrongly assuming that, well, this is the United States. You won World War II. You've got the world reserve currency. This thing could never fail. It just could never. And yet, if you look at all of the factors that we see taking place, enormous and
Mhm.
growing deficits, a huge gap in wealth inequality. These are all third world country kind of issues. And generally speaking, I mean, Reinhoff and Rogart did a book on it and show that when countries get to the point where debt is over 100% of GDP, and we're close to 130 right now, there really is no way out. You are kind of in a debt trap. And as a result of that, we either need to do a currency reset, which is unlikely because nobody even understands the issue, or you're going to have massive inflation, arguably potentially hyperinflation. But you could get out through massive inflation over a bunch of years until things kind of return to normal. But there's really no way out. And so I think one of the mistakes that a lot of investors, a lot of people are making, and it's rather sad because everyone's complaining about the inflation, and now we're somewhat happy that it's kind of come off the boil. And it has a little bit in certain areas. I mean, certainly in rental properties, it's come down a bit, but I'm not sure the food inflation is as low as they say it is. But the point is that inflation is going to continue to flare up again and again and again because of the underlying issue that this chart lays out, which is they are going to continue to increase the monetary supply. They have to. If they do not, the economy will collapse.
Yep. All right. Can you turn the screen share off then?
Yep,
And
I'll
we'll
turn that
carry
off.
on.
Yep. Okay.
Yeah. All right. So, yeah, this is the big setup now. And of course we get back to who's going to eat the losses, and you know how the system would like to roll, right? They would like to create, well, the Fed tells us straight up, we're going to create 2% inflation, which means we're going to steal half your money every 35 years using the
Right.
rule of 72, right?
Right.
They just tell you flat out, and people are like, oh, that's very nice. Thank you for managing that. May
Yeah.
I have another, sir?
Yeah.
What is this, a hazing ritual, right? It's just awful. But now they've said, well, we might float the target to 3%.
Right.
We'll just steal 3% of your wealth every year. And of course, 3 into 7, that means every 20 years, they're going to take half my money, right?
Right.
So it's can you imagine if the government said we have a taxation program where we're going to take half of everything you've earned every 20 years, we'll take half in
Yeah.
addition to all the other stuff we're going to take, right? It's just,
Yeah. I
it's
mean,
unacceptable.
look, I mean, yeah, the Patriots had a revolution over, a fraction of this in terms of taxes. And as I'm sure you're aware, Chris, and many of your listeners are too, the 2 and 3 are fake numbers. I mean, they're saying we're at 3, but if you go to shadow government statistics or you go to Chapwood, I mean, everyone knows that the actual inflation that we are all experiencing is much higher than the reported inflation. So it's really actually quite worse. And that's, I think, what's leading to the dissatisfaction throughout this country. I mean, I think don't polls show that like 80 or 90% of the country believe we're on the wrong path and that things are getting worse? I mean, we are deep into the fourth turning right now, as you and I both know.
Yeah. So let's I like to well, I track the signpost because I like to know beforehand is something going to break here.
Yeah.
But let me go back to anecdotes. I put out alerts very rarely for my subscribers, right? An alert I define as a piece of news that causes me to do something, right?
Right.
If I saw like, mortgage insurance companies cratering like I did in 08, I ran down to the bank and got cash. So that was an alert for me. But I had to put out a soft alert the other day, Lawrence, because something was just wrong. Like, it's just wrong. and I'm polling all these people I know from all different sectors. I get on extensive long phone calls, and I have a pretty deep Rolodex of connections. So I talk to people all the time, and we're all sharing the same feeling. Like,
Yeah.
something's wrong. And finally, I was able to coalesce it down to this one question I could ask. Have you been waking up mysteriously with a sense of dread at 3 o'clock or 3:30? Right. And
Yeah.
about half the
Three.
people I talk to,
Three.
their eyes widen up. They're like, how did you know? Right.
How'd you know? Yeah. Yeah. Well, yeah, I mean, I call it rivets popping, and a big rivet popped in September or in March when Silicon Valley Bank failed. But since then, I mean, we've had a terrible 30-year bond auction. We've had the Japanese have had to, lighten the band on their 10-year, bond. We've had, the ICBCI Bank was, running around with a computer stick to participate in a government auction. I mean, there've been all kinds of little there've been all kinds of little signals that
Yeah.
something's not right. And that's kind of how it feels to me anyway, that in the financial world something's not right. I mean, the stock market has been rather eerily hanging in there on almost no volume. So that kind of feels a little bit rigged to me. And
Well, you'll know this. So in the last week, I think it was about 2 weeks ago. So all of a sudden, the stock market is just starting to do its power higher thing, right?
yeah,
But in the
yeah,
week right before that, I watched the VIX get slammed by close to 30%, right?
exactly.
Just smashing the VIX. And this is a little wonkish for people listening, but the VIX is a derivative, right? It's supposed to track the volatility of the market, and it trades as a literal derivative on the CME. You can sell puts on it, you can
Yep,
smash it, there's futures. So somebody smashed the heck out of it, but they only got about an 8% climb in stocks, right?
right.
That to me was a popping rivet, because normally it's a little more, there's a more proportionality, right?
Yes. Yes.
And I watched them, Lawrence, leaning on this. The market would be going down and they'd be smashing the VIX, just
Yeah.
monkey
Yeah.
hammering it to get it to
Well,
go the other way.
I mean, some of your listeners know this, some probably don't. I mean, they've got a $286 billion exchange stabilization fund at the New York Fed that can basically trade and manipulate markets. And and they've admitted this. I mean, at the bottom in 08, when the market was literally falling apart, they just got in there and started buying the futures in size and just said, this is it. We're not letting it go any further. And they
Yep.
do this. They do this at key points in time because, frankly, I mean, there are several things. I mean, to me, the level and health of the stock market, the bond market, and the price of gold are as important as the nuclear codes. I mean, to the federal
Exactly.
government. I mean, these people know that having a, I mean, they've studied the Great Depression. They know what happened. They saw how things cascaded into a spiral downward. And, and even I mean, it started in 87, Greenspan, and I was trading then. I was short in 87 when that went over the cliff, and I made some money that day. But, and Greenspan came out and he established, the president's working group on financial markets, otherwise known as the Plunge Protection Team. And then they set up the Exchange Stabilization Fund, and they funded that with billions of dollars. And they set up accounts in the Cayman Islands. And, I mean, I'm sure the Pentagon is to some degree involved in all of this, and that, the powers that be know that they need functioning, safe, non-scary financial markets. And so they intervene when they see the opposite of that. That's just a fact. And so that's part of what we're playing against. But what we, the advantage we have is we know that they've got a losing hand, and we know they've got to continue to print. So the way to front run them and to trade against them and to make a winning bet is to be in sound money things, because there's just nothing more certain than the fact that they're going to try and print their way out of this. That's how I see it.
Of course they'll have to. And I get into these things all the time. People are like, oh well, the Fed. What are you suggesting? I'm like, what am I suggesting? I'm suggesting someday we'll see $100 trillion Fed balance sheet.
Oh,
Someday
absolutely.
we'll see a quadrillion-dollar balance sheet. Yeah.
Yeah, no, I mean, I think we've got 3 or 4 more cycles in it, but there's no question the next print. I mean, as you'll recall, the 08 print led to kind of, I think we were under 800 billion in Fed balance sheet pre, Lehman failure. We came out of that, and we over time ramped up to 3 something, and then they started to take that down just a little bit. That didn't work. Powell had to pivot, and then COVID hit. The fake virus, and boom, we're at 9 trillion. And now that's come down a bit. We're down close to 8. It's a Fed balance sheet size I'm talking about now. Now we're back down closer to 8. But okay, fine. But the next one's going to be at 22. It's going to be, and by the way, these are just the stated numbers after the damage cleared. I mean, there was some great FOIA requests that figured out how much money when one of these events occurs, the amount of money they put into the system, it's mind-boggling. I mean, in the 2008 case, they grew the balance sheet by 3 or 4 trillion. At one point, I think they had 15 or 20 trillion dollars in swap lines out to the entire world. I mean, they made it extremely clear. We are not going to let anybody go bankrupt. We are going to give you all the money you need until the herd calms down. Because I mean, and that's really what they can't have. All these events are like the herd is panicking. The herd sees a rattlesnake, or the herd sees a mountain lion. It's about to pick them off, and so the herd just runs like hell and says, "Get me out of these securities." And the Fed, the response of the Fed is, "No, calm down, guys. We got this. We got this." And they do, but the cost of having it is they're going to print a shitload of money, which makes every unit of the money worth less.
Yeah, and so I mean, just editorially, because I can't resist here. The whole idea is like, look, we had the Greenspan put, right, 1987. He bails that out. We had this corporate bond market hiccup in 94, bailed that out, implemented the sweeps program, which effectively removed reserve requirements from 10 to 0. Then we had the 1998 long-term capital management bailout, and then we had the 2001 bailout, and that led to the blowout money printing, which gave us the housing crisis, which gave us the great financial crisis. And people aren't generally aware of this, but we had another crisis in 2011, 13, 17, 19. This is just managing crises. And nowhere along the way did anybody bother to go, maybe we shouldn't have too big to fail banks. Maybe the path is we should fracture this, and we should have lots and lots of little distributed, decentralized, points, so that if any one of them fails, the whole mesh doesn't get taken down. But instead, they've been going the other way. Correct. And then they use the concentration as justification for a bigger bailout, which gives us more concentration, which would be a bigger bailout.
Right.
And meanwhile,
and they keep kicking the can up. I mean, originally we were at the .com level. Okay, technology is a big piece of the economy, but it's not the whole economy. Then we're at the housing level. Okay, well, that's a little bit bigger piece of the economy. Everybody's got a house, right? And the banks are pretty big. Now we're at the everything bubble, right? We're at the sovereign credit debt level, and it's not like we're going to have Martians come down and save us here. I mean, they're playing. It's Deus Ex Machina. I mean, they're playing for all the marbles with the underlying value of the currency. And, because they're pretty good at it, because they've got all the levers, and because, they can push and shove them back and forth, my sense is we probably have a couple more swings here. I mean, I believe that ultimately this will resolve with either a reset or hyperinflation. I tend to lean towards hyperinflation, but I also believe we've probably got a couple more swings back and forth throughout the process, and that kind of total currency failure doesn't occur until the 2028, 2030-ish timeframe. But I'm quite sure on the next leg up that gold will go through 3,000 or 4,000, and gold stocks will take flight. I'm quite sure on the next leg up that inflation will get hot again, probably hotter than it was in this last cycle. Gasoline prices will be higher, and sadly, people put up with it. We should be marching on the Fed, but most people don't even understand that that's the core of the issue, which is unfortunate.
I'm not a conspiracy theorist, but I actually am.
Well, most of them have been proven true, so it's actually kind of a compliment. Somebody called me that the other day, and I viewed it as a compliment.
So I don't want to see a bug behind every corner here, but let's talk about gold real quickly here, because sure. I'm convinced, like you are, that the markets are important signaling devices. Of course, they're also the devices by which the power elites and the insiders ring the cash register on a daily basis, right? And I think they've done this with almost all commodity markets. Remember, so I'm like, you're probably one of only 3 people in the world who will be similarly outraged, right? But to me, there was this 2015 Reuters article that said, the New York Fed was scared by Superstorm Sandy, so they moved their trading desk, which is the most powerful trading desk in the world, to Aurora, Illinois. I'm like, that's weird, because that's where the Chicago Mercantile Exchange is located. Isn't that a fun, of all the places?
Wow, what a surprise. Yeah.
And then it was just the next year that the Chicago Mercantile Exchange announced their central bank preferred buyer program, because they're such heavy consumers of CME products that they get special pricing. I'm like, why would central banks need futures and and options on things like metals, grains, oil, gold, stocks, bonds? Like it's just what? And nobody will admit I've been to every central bank balance sheet because I'm a wonk. I look around, you can't find a single one of them that admits they have any stock futures or commodity futures or play in those markets at all, but they do,
Of course they
right?
do. Yeah. I mean, an exchange stabilization fund keeps growing. I mean, what for? If they're not using it, then why does it grow? I mean, you can Google it and find it. They have reports on it. They just don't tell you what they do. And that's why Ron Paul and others were so adamant about auditing the Fed. I mean, what
Yep.
we really want to see, what these guys are doing. Yeah, this is great. This goes to what I was speaking about earlier, I guess pre-recording here. Gold, what's interesting to me is that,
Look at the
this,
firepower. Look at
right,
they clearly have a point of view. I mean, this is a beautiful cup and handle from a charting standpoint, but they are
absolutely.
expending
Yeah,
all kinds of firepower to keep this under 2000. That seems like a real line in the sand to me anyway.
it is.
Um,
It is. And when it goes through that, as you know, with algos and the way people chase all-time new highs, gold's going to squirt through 2100. It's going to be at 3000 before we blink.
mhm.
And that's going to be, really meaningful for both investors in gold, also investors in silver, also investors in the mining companies, which have just been beat to shit. I don't know if you have the ability on that chart, Chris, to overlay something like the Huey or the
I
GDX.
don't on this one, but
Doesn't go back far enough. But the point is
yeah.
that if you did, there's a line, the GDX is I mean, same scale. The GDX is trading at a level close to where it was in '08. So the gold stocks have really not participated in the run in the metal. And people might say, well, how can this be? I mean, I find this chart incredibly informative in another way too. And this gets a little wonky, but it's important. We took interest rates from zero effectively to 5.25% in terms of the Fed funds rate. So that's
Mhm.
a really meaningful increase in the real rate of interest. Of course, it still isn't positive because inflation's understated. But the point is, in the past, when that has happened, if I could show a chart, I don't have one easily accessible, but gold and real interest rates are very highly correlated. When real interest rates
Yep.
get higher, gold goes down. That's how Volcker broke the back of gold in 1980. And but that's not what has happened this time. Real interest rates have gone up quite a bit as a result of this fundraising, this interest rate, increasing campaign, and yet gold has hung in there. And I think the reason that has occurred is that because gold smells the printer, gold knows
Mhm.
what's coming. Gold knows that mathematically these people are trapped and that they will
Yep.
have to print more money to keep the system going. And, right now, I mean, all the Wall Street cheerleaders are saying the stock market's fine. And I mean, I find it amazing. I go on Bloomberg and you'll find this interesting. The consensus 5-year out forecast for the price of gold is $1,750 an ounce. It's trading right around 2,000 now. So the
Yeah.
consensus Wall Street forecast is that gold is going to decrease in price in the next 5 years. I mean, in my view, the odds of that are zero, absolutely
Mhm.
zero. I mean, in 5 years, gold could be at 15,000, it could be at 10, it'll easily be at 4, and maybe it's only at 3, but I highly doubt that. I think it'll continue to trend upward because I think they'll continue to print money. And gold it's the ancient form of money that governments cannot print. And
Which
so,
is why they hate it, of course.
of course,
It's
right.
they do hate it, but so I four most dangerous words this time is different, but can we talk about what's different now? So a lot of people look back, oh, here's what it did in the 70s and here's where it was in
Yeah.
'08, all that. But if we go on a look forward basis, two big things to me. First, moving from a unipolar to a multipolar world, China clearly has a stake in the game. The United States has just lost an extraordinary amount of what little remaining integrity and reputation it had. We got the combined warehouses of NATO got spanked by a Russian military budget that is 1/10 the
I know.
size of
I,
just the US
I know.
military budget alone,
I
right?
know. I
They
know.
showed that some $50,000 drones can take out $5 million pieces of hardware, M777 howitzers, Bradleys, all of it, right?
Right?
So that's a game changer right there.
Yeah.
China's busy making diplomatic inroads. They got Saudi Arabia and Iran to shake hands and reopen diplomatic
Yeah.
arrangements,
Yeah.
Shia and Sunnis, weird, but they did it, right? So I'm watching all of this unfold. And then the second big piece that relates to that to me very tightly is that we have an administration here in the US that is exceedingly hostile to energy, in particular oil. And it's
Yeah.
canceled leases, it's drained the SPR, which I consider an act of national vandalism at best. terrorism at worst,
I
right?
agree.
That's done by somebody who hates this country and wants to see it suffer, right? Is how I look at that because it's that serious. And meanwhile, if you just look at where even JP Morgan's commodity desk, Lawrence, a month ago came out and said, there's a persistent shortfall in oil that we can't do anything about that starts in 2026 and just stretches as far as the eye can see. And they predicted a 7 million barrel per day shortfall by 2030. As we know, there's no such thing as a 7 million barrel a day shortfall in oil. There's only one of two things: a sky high price to settle out the demand, or a war to fight over it. Those are your options.
That's right.
So yeah, I'm looking at all this going, these are new overlays we have to factor in where, yeah, those are different features that haven't been here prior. I think they're important. What do you think?
I think they're very important. I think the other, you kind of touched upon this, and this was incorporated in the JP Morgan report, which I read as well. We got lucky in the last 10 or 15 years. I mean, shale oil was really kind of an amazing gift, and fracking. I mean, we found a bunch of oil really cheap, and cost of capital was very low, so the capex didn't cost much. You borrow almost zero, and we suddenly became a larger oil producer than we ever were, or than we'd been for quite some time, and that was a gift. But if you go to Rosenzweig and Gehring are probably the premier guys that do the analysis of the shale oil fields, what you see is that they peaked and they're starting to roll over, and the cheap shale's not there anymore, and even the expensive shale is declining. And I mean, will we be able to get more oil? Will that 7 billion barrel gap get filled? Of course it will, but not at today's price, not at $70. I mean, we're going to need 150 or 200. And if you kind of imagine where we are in gasoline prices today at kind of $70, $80 oil, double those oil prices, double the gas prices. Not quite linear, but it's directionally it's very similar. And so yeah, I mean, that's a big deal. And the world runs on energy, and to the degree that we are in a tighter energy environment. I mean, again, Chris, this is also driven by just the whole fact that with all the financialization, all the bubbly stuff that we had going on from 2008 to 2022, and I mark the peak as December of 2021. Okay, so that's when I think that everything bubble started to burst. All the money and all the capital was going into the Magnificent Seven and the FANGs and tech stocks and basically the NASDAQ. And if you go and you look at the same time frame and you look at capex that's been spent on increasing the production of stuff, the things that make the world run, or the things that we eat, farm things, the capex there has been just completely starved for 10 or 15 years. And so that's why earlier in this presentation, I said I really do believe we hit peak deflation in March of 2020. It doesn't get solved easily. We need to expand our capacity in everything that's real, that's physical, that's commodity oriented. And another chart that I can't easily access and pull it up either. Maybe I'll see if I have my report, but it's easy to access for anyone who wants to Google it. Just Google, the S&P 500 as compared to the commodities, and commodities.
Oh yeah.
You know the one I'm talking about. I mean,
oh yeah. I actually showed it to my subscribers. I don't know, yesterday, I think, or the day before.
It's all over the place. But the bottom line, what you can see is that we've really underinvested in commodities. Commodities are silly cheap, and the S&P on a relative basis is silly expensive. And that will reverse, just like all trends are in financial assets tend to be mean reverting, and we're at very, very large extremes. I mean, gold. Ironically, gold's at $2,000. It's near an all-time nominal high, but compared to the money supply, it's actually near an all-time low. I've said in the past, and I love this math. In 71, you could take the money base and divide it by the 261 million ounces the U.S. holds, and you come up with a $35 reference price from Bretton Woods. Okay, if you did that same math today, you took the monetary base divided by the 261. Price of gold would have to be $80,000 an ounce. $80,000 an ounce to balance the two. It's at 1950.
And that's assuming we have the 261 million
ounces. Well,
that's
a whole. You're right. But like us non-conspiracy theorists, it's probably quite likely that has been looted or in some way pledged or encumbered. Although who knows? It could be there. We don't know. It does strike me as very odd. I mean, one of the reasons why I feel pretty strongly you're right about that is that we've been asking for an audit. Many people have asked for an audit since the 50s. And you know what their excuse is? It would be too expensive to audit it. Now, we spent $6 trillion wasting, lives and treasure in the Middle East. And how much would it really cost to audit 261 million ounces? I mean, it's got to be less than $10 million, right?
$10 million.
Right, exactly. I mean, it's a joke, but they're not going to audit it. Just trust us, it's there. So,
Yeah.
but it's,
Yeah,
but
now
it's another national security issue, right?
So you'll love this. Maybe you can answer this. This is my stumper. If I ever want to stump somebody, guaranteed bar bet I win this. I can show you that on the Exchange Stabilization Fund, which is a treasury balance sheet, I show you that they will list those 261 million ounces of gold as an asset on their balance sheet. They're
47
listed.
bucks. Yeah.
Yeah, $11 billion, but at $47 an ounce, there they are. Yep. I can also show you that the New York Fed has those same 261 million on its balance sheet. I'm no accountant, but I'm kind of wondering how two separate organizations, which are not commingled, by the way, the Federal Reserve is not a government entity, everybody. Yeah. It's a private bank. They have the gold listed on their asset side of their balance sheet. The U.S. government has it listed as an asset on their side. This is the kind of stuff Enron went to jail for, but I can't resolve. Like, this should be a simple question. Who actually owns that gold? Me or the Fed? And as far as I can tell, in public records, both claim ownership.
That's correct. And I've had the exact same concern. And it just goes to show you all the funny business these guys have done. I mean, it really is you. I mean, it was the government's gold. It is the Treasury's gold. But in theory, I think they've either lent it or somehow they let the Fed put it on their sheet. I don't understand that either. I mean, look at the whole Fed balance sheet. There's another thing. I mean, or the Fed losses. I mean, the Fed is losing an enormous amount of money, and they're putting it up as a deferred asset, which is a joke. And and if they were to mark their balance sheet to market because they've got all these underwater bonds, I've heard some guys have estimated they'd have to take a $1.5 trillion impairment on their balance sheet. But again, when you own the printer, you can make the rules. I mean, this is Meyer Rothschild, right? Give me control of the monetary system, and I don't care who makes the laws, because having the money basically allows you, if you've got more money than anybody else, you can rig the game in your favor. And that's what they've done.
Yeah. Well, so let's talk about the positive side of all this, because, I just wrote this about silver. So I did a deep dive on silver, right? So silver is the same price today that it was 10 years ago. Actually, it's 30 cents less per ounce, right? So it's gone nowhere, right? The cost of mining has gone through the roof because inflation has been high, but particularly in mining, where they're heavily dependent on things like steel and oil, it's been much higher than average, right? Yeah. As well, we have depleting ore bodies, so you have to get more stuff out of the ground, so there's more effort per unit to extract, et cetera. So against all of that, like, we have as well, over those same 10 years, Lawrence, 6 of those years have been in structural deficit. The last 2 has been 240 and 116 million ounce shortfalls in each of those years. So name me another commodity where it's been in structural shortfall 6 years in a row, mine output is falling, and the price is lower.
Yeah, well, there isn't one. And again, it goes to manipulation. And I know how that structural deficit is getting solved, because I go down to my local coin dealer every now and then to buy some coins, or just check in with them. And I see the T-sets from the poor, older people that live in the New England region that basically are down to their last, X number of pounds of silver, and they take them in, and my coin dealer weighs them, and he's going to send them out to get melted down. I mean, that's part of how they're solving it. Yeah, no, there is. I mean, in my view, right now, there is no asset on the planet that is cheaper than silver. I mean, it's insane how cheap it is. I mean, it hasn't even, it hasn't even gone on to a new all-time high. I mean, or even close to it. I mean, the all-time highs were 50. When the Hunt brothers tried to corner it in the 70s, and then there was another 50. Back in 2011, and it's 26 now, or 5, I guess, roughly. So, it's, and the underlying demand for it's growing, Chris. I mean, you need it. If we're going to go to EVs, you need it. And if we're going to do solar, you need it. And I've seen estimates that, right now, solar consumes about 15% of the silver that we dig out every year. I've seen estimates that in as little as 5 years, half of the demand will be for solar. Half of annual silver demand will be, and as you say, silver supply is not growing, it's actually shrinking. And that goes to my earlier comment about how we've underinvested CapEx in things that make stuff. And that's why,
Well,
if I were advising, somebody young coming into the workforce today, I would say, go away from financialization, go away from technology, go away from all this sizzle stuff, and figure out how to get into industries and businesses that make real stuff. Because I think stuff is going to do extremely well in the next 5 or 10 years. And if you can produce more stuff cheaply, that's going to be a very important quality in business.
completely agree. Absolutely. So, in particular, when we look at the solar demand, and listen, we might, something might come along to disrupt that. Maybe we'll get thorium reactors or something, and we'll go back to nuclear or something. We won't need as much solar, whatever. But the trends right now are as fundamentally bullish as they can possibly be. And I think this creates an opportunity because it used to be that there were producers and consumers, right? For wheat, corn, oil, silver, all that. And then the futures market came along and said, wouldn't it be good for a farmer to be able to sell off their September harvest, but it's January? That way they have secured cash flow. The consumer side, the big, grain mills or whatever, they know what price they're getting. Everybody's happy, right? So it was good. But then that was the signal in the system. And then speculators came on. They provided liquidity, right?
Right.
Greenspan really enabled this, and because he was all about the liquidity, and he was a mumbling fool. But this whole thing started to take off. And now, Lawrence, I look into these markets, particularly commodity markets, and I see that it's almost all noise, no signal. It's 99% speculators doing what they do, right?
Right.
Trade in paper silver, paper gold, paper oil, right?
Oh yeah.
Those same signals we used to see that I still see in the silver market, where it's like, oh, this bid crushing, sell order comes in, just smashes through the bid structure, right? And just
Right.
crushes the price. I watched that happen in oil multiple times this year. And I'm like, oil? That's a big market, but somebody would come in with an urgent need to sell 2 million barrels in a 1 minute tick, and I'd be like, that's not price discovery. That's price
Manipulation.
manipulation. Yeah.
Absolutely. That's
Yeah.
absolutely, and there's a ton of that. And I mean, look, in the silver and the gold market, it's a big game of musical chairs, right? I believe that there's somewhere between 100 and 1,000 claims on every ounce of gold that there is in the world that are in paper. And so, what do I mean by that? I mean, I don't think GLD has the gold they claim they have. And I think if everybody who owned a share of GLD said, I want to trade my shares in and give me my fractional amount in gold, the price of gold would go up multiples, a factor of 10 or more overnight. And the reason for that is just that the gold doesn't exist. And so when the music stops, this is where possession will be 9/10 of the law. Somebody, I mean, you might have somebody who says, I sold you a contract to deliver gold at XYZ price at a future date. The problem is that party that sold it to you might be Lehman Brothers. And so when gold suddenly does a moonshot, which I think it easily could do on a monetary reset, then Lehman's not going to have the gold to deliver, and they're going to say, "Oh, sorry, we'll cash settle." And I mean, and you've seen some of this, Chris. I mean, somebody got squeezed in the nickel trade, right? Remember that
Yeah.
a year
Yeah.
ago?
Yeah. Yeah.
That's all that was. It was paper nickel, and somebody said, "Hey, give me the goddamn metal." And you know what they did? They changed the rules. They screwed the guy.
Yeah.
And they do that kind of constantly. I mean, they really do. But at some point in time, they change the rules. But what happens when you change the rules and the other party has nuclear weapons, like it's China or it's Russia? And in the case of Russia, you just stole $600 billion of their assets. And that's why you see these other countries and central banks hoarding and grabbing gold and going after real assets, because they know that the US is not trustworthy. And that's why you see them trading with one another in their own currencies, not using the dollar. I mean, you see India, you see, the Arab Emirates, etc. These are all these countries are now accepting yuan and rubles for goods and commerce, and the dollar is getting shoved out. And that's all because the United States government has behaved so irresponsibly. And we're not in a hot war. We're not in a World War III hot war, but we are in a
Yet.
World War III currency war, very much like what Jim Rickards has said. There is a currency war taking place right here, right now. And America has been living beyond its means as a result of having the reserve currency. And that privilege is being taken away as we speak. And so Americans who save their wealth in dollars need to think hard about whether that's the right thing to be doing. That, if they should have that dollar as their savings unit, or the savings unit should be something that can't be printed.
Yeah, I think if you couple of sayings. One is if you've been at the card table 30 minutes, you don't know who the sucker is, right?
Yeah,
The second I would say is sort of related is if you think you're in a game of musical chairs, the only sane thing to do is grab a chair early.
exactly. That's exactly right. And it's hard because, it hasn't happened yet. And, gold bugs have been saying, hey, this thing's going to reset for years. And, I look stupid and I've been wrong. It has gone up. I mean, when I got involved, gold, back in the, earlier days, it was at 250, in 2000 when I started buying gold. And it's at 1900. It's gone up at about 8% a year. It should have gone up much more aggressively than that, but the suppression has held it back. But, it's, to me, it's one of those long-term macro trends that's easy to observe, sometimes tough to ride the ups and downs, but the underlying trend is solidly up. And I think we're kind of getting closer to the end of the road because, the contractions are coming more often and they're getting larger, right?
Yep.
I mean, we had a contraction in 08. They calmed it down. Okay, fine. We were good for another, well, I guess 16, 17. As you point out, there were some things in the middle teens that were bad, but I think the repo blowout was the first real sign that, there's a problem here. And that was 2018. And then of course, COVID came along and bang, they had another excuse and off they went. And there will be another one. I mean, I don't know if it'll be World War III. I don't know what it'll be, but there will be another one. They will find another excuse. There will be a reason to print. One thing that could be that I'm watching pretty carefully, and I don't think the world has really focused on it enough, is the regional banking system in the United States. I mean, the whole banking system in the United States really kind of broke in March of last year. And, they changed, first of all, they violated the law. Dodd-Frank, black letter law. If a bank fails, the depositors are going to take a hit. Oops. Unless, of course, the bank has Bill Ackman as a friend who can cry on TV and has a bunch of wealthy VC clients. Oh, and it might represent contagion. In that case, we're going to change the law again and we're going to bail them out. And so if you look at the regional banks today, I mean, there's $600 billion in balance sheet losses. I've seen estimates that would suggest that half of the regional banks in the United States today have negative equity. Now, there's $17 trillion of bank deposits in the banking system in the United States today. And the FDIC has a couple $100 billion under management. That's the insurance fund that will pay you if your balance is less than 250. So if the banks started to fail en masse, the Fed would have to fill part of a $17 trillion hole. And that's how you get to a Fed balance sheet north of 20 million very easily. And of course, when Silicon Valley Bank was failing, I mean, Janet was even kind of waffling around. Well, maybe we will guarantee the deposits. Maybe we won't. Maybe we will. Maybe we won't. They were obviously scared about it. And if you're following commercial real estate now, and it's easy to do, there's some good guys on Twitter of a lot of commercial real estate stuff. One guy's called Triple Net. You're seeing $80 and $90 million buildings selling for $20 million. Well, that's a big loss. That's a lot of money. Yeah, I'll forward them to you, Chris. That's lot of money. That's a lot of money going to money heaven. And that, so if you got a $90 million building and the builder, the real estate developer put in 20, borrowed 70, and the building's now worth 20, well, guess what? And the investor walked away. And so, the 70 million that was loaned against it, they're getting 20 back against that. I mean, that's a direct hit to that bank's balance, whoever made that loan's balance sheet.
Yep.
That's going on all over the country. So there's a real lurking regional banking crisis that the Fed is at some point going to have to figure out a way to deal with. Because they can't have they can't have half the banking system fail. They just can't, right?
No, but maybe this is part of the whole consolidation thing, right? So Signature and Silicon Valley break, right? And what happens? JP Morgan picks one of them up and First
for sure
picks up the other, right?
So
the big ones get bigger, right? Oh, but I was trying to pull up a chart which I consider monetary vandalism, right? Where those 8-year stretch of 0% interest rates that forced the banks who have reserves to get into like treasuries at the bottom. A 10-year was what, 0.56%, right?
Absolutely.
And then whoops, pull the rug out. And now they're at 5%, and they have a run on the assets there. And of course they're going to be what their long-term treasury holdings are down what 30%,
60%, 50 to 60%, depends on which.
50. Oh my God, you can't survive that. But the Fed created the situation
Of course they did.
in both scenarios,
Of course they
right?
did. Of course they did.
Yeah.
And it's just it's gross monetary mismanagement, but and it's monetary mismanagement to benefit the people in the system. I mean, all of the banks in '08 should have failed. I mean, they should have, I mean, I remember
Good
very clearly
riddance.
Paulson was on his knees begging to Nancy Pelosi saying, if you don't give us TARP, the ATMs won't work tomorrow morning. And what Nancy should have said is,
Martial law, he said.
yeah, you're right, right. And what she should have said is, fine, here's TARP, and I want you and your entire board of directors and anyone who accepts this TARP money, the senior management and board of directors, I want all your resignation letters on my desk in the morning. And I'm going to
Mhm.
go to the Midwest. I'm going to get a bunch of conservative Midwestern or South or wherever. I'm going to get a bunch of small town bankers, and I'm going to put them in charge of Chase and Goldman Sachs and all these big companies. We're going to rebuild this thing, right? That's what he should have said. But what they said is, yeah, here's your money. And a year later, they were paying record bonuses, and they all became billionaires.
Yep.
It's crazy. It's absolutely crazy.
Yeah. So, I mean, again, the positive this for me is that I actually, this is weird to me. I'm a very patient investor. I actually like being able to buy things on the cheap, right? And
Absolutely.
they've been playing their little shenanigans, and they ring the silver cash register and they bang gold down. To me, that just gives me a more time to get it at a better price. Maybe I'm deluding myself, but to me, it's just simple. I think fundamentals come back. You know,
Absolutely.
back in the day when I started financial analysis, and I did it for a period of time, you began with a financial report. You began to do sort of forensic things. You have to look at things like accounts receivable and cash flows and all this stuff. Nobody does that anymore, right? But I think that's coming back into favor. But the
Oh, absolutely.
fundamentals on commodities right now, it's just like it's the most brain dead simple thing ever. It's like fifth grade math, like supply, demand, subtract the two. Uh-oh, you know,
Price is
that's a
going a lot
problem there.
higher. Yeah, no, no. I
Yeah.
mean, this is an amazing, in my view, this is an amazing opportunity for people who are willing to think outside of the box. And because the average Wall Street firm right now, I mean, I think 70% of Wall Street has less than 1% of their capital in gold. And I mean, these people just they don't see it, and yet it's staring them right in the face that the
Hmm.
monetary system is broken and that the debasement is accelerating as we speak. And I think we're going to have a gold and silver stock mania in the next 5 to 10 years. I mean, I think people are going to be, and of course at that point in time, I might be selling some of my stuff, but I think you're going to, hey, did you buy Newmont? Did you buy Barrick? I mean, the kind of talk that occurred in the last 20 years about Nvidia and Apple and Microsoft and the FANGs and all that stuff. I think that's going to be, you're going to see commodities companies are going to have that kind of a buzz about them because they're going to go up just consistently. If this
Hmm.
decade looks like the 70s, if you look at the 70s, the two top performing, which was a decade of inflation, really, and it's because we went off the gold standard in 71. If you look at that time period, the two top performing asset classes were gold stocks and oil stocks, and they compounded, Chris. 10 years compounded at 34% a year, both
Hmm.
categories. 34% a year compounded. I mean, it
Wow.
was insane. It was absolutely, and I think that's what we're looking at here. We're looking at an inflationary decade like the 70s, and these things are going to just rip. And so, I've obviously got all my eggs in this basket. I can't legally give investment advice, but people can draw their own conclusion. I think to have zero eggs in this basket is kind of crazy because to
Hmm.
me, it's kind of a no-brainer proposition that they will print the money and that this inflation will occur. And these are the this is the asset category that will benefit the most from that inflation. So,
Well, I agree. So let me take the devil's advocate side, at least in the
sure.
near term, which is that Jerome Powell's kind of the first Fed chair. Listen, I deplore what he did in terms of doubling the balance sheet from 4 to 9 trillion.
Yeah.
During COVID, that was dumb, Jerome. But now he looks haggard. He looks like he's aged about 10 years in the last
Yeah.
one, and I think I'm starting to believe that he is going to keep rates high until something breaks. Do you
I agree.
believe him? And if so, what would have to break for him to pivot?
Yeah, those are great questions. yeah, I don't particularly like the guy, but I don't think he's as evil as Bernanke. I think Bernanke was really evil. And I think Powell actually, in his heart of hearts, is trying to do the right thing. I don't think he really knows what the right thing is. And I'm with you. He printed too much, then he tightened too late. He's done a lot of things wrong, but I think he really believes what he says. I don't think he's actually a total bullshit artist. He wants to stay higher for longer if he can. Okay. The breaking is the issue. And we know for a fact that the third mandate is continuous financial markets and continuous and functioning financial markets. And things are creaking and breaking. I mean, Silicon Valley Bank, that was kind of a break. You know, the recent 30-year auction where you had a 6 bp tail, that was kind of a break. I mean, things are not going great. My suspicion is they're going to hang on absolutely as long as they can, but you can see them already starting to plant the seeds of the pivot with the maybe 3% is the right target, not 2%. And maybe the market, 10 Fed governors came out and said, the market's done its work for us. We're starting to see a slowdown. And my suspicion is, Chris, he will hang on longer probably than he should and longer than many people expect. But the market will front run him. The gold market will front run him and will blow through the 2100 level. And on top of that, eventually something really big will break. That, it'll become, increasingly obvious that we've got a serious economic downturn going on. We'll see banks failing. We'll see massive layoffs. We'll see a big declining stock market. We'll see some really serious problems. And at that point in time, I think he's a political creature. And, my sense is he will pivot. Recall, this is a guy who told us that inflation was transitory, and then I'm not even thinking about raising rates. And then 4 months later, started the most aggressive rate raising campaign ever, absolutely ever. So this is not a guy who's before, and this is a guy who was tightening and said the balance sheet, it's going to be watching paint dry, right? And then we had a repo blowout, and bang, he did a complete 180. So as much as I think he's trying, and as much as I think he's bluffing, and he will hang on as long as he possibly can, I think there will come a break point. And I don't think there's no way in my mind that break point is less than a year, or is over a year away. I think I think it could be months, maybe it's a quarter, maybe it's 2 quarters, but I think by next year we're in it. Things looking really bad, and he's going to just he's going to figure out a way to rewrite the narrative. Remember, they get to write the narrative any way they want. He'll say, hey, we didn't get the inflation exactly where we wanted to be, but we thought we were substantially done, and we think the trends are good. So we're good, right? We're good. And we'll just stop this QT. Oh, and by the way, we're going to create this BTFP2, and by the way, that'll be interesting to see. That was supposed to be a 1-year program. It'll come up for renewal in March of next year. Now I'm here to tell you
this program. What was this one again?
The bank term funding program. Remember, they did that when they bailed out Silicon Valley Bank. That was a 1-year swap line with all those banks. And they're supposed to be unwound in a year. So in March of 2024, those banks are supposed to pay back that money, but they don't have it. They can't. So, they'll extend it and they'll kick the can there. And so, look, it'll be incremental steps until there's a big break, and then it'll be all at once. And he'll go crazy. He'll take rates to zero. He'll reinstate QE. They'll do yield curve control, all of it. They'll have to. They don't have a choice.
So I have to ask you then. That's great. I forgot about that, the BTFP. But remember, so Janet Yellen just came out like a couple months ago. Treasury Department said, "Oh, we don't like the volatility in our cash balances at the Treasury." I'm like, "What volatility? Cash comes in and it drains out like a pool with a hole in the bottom." Right. So what they were going to do was they were going to have the Treasury step back in and buy treasuries off the market. And I was thinking, okay, this has to be a backdoor bailout, right? Which is like the Treasury will go in and call out bonds that are at 0.5% 10 years. They'll buy them back probably at par, if I had to guess.
Yes.
And,
well, they've already announced it. They've said we don't like the way some of these longer dated off the run issuances trade, which is, of course, they don't trade because they trade much lower than what they were issued at. And she said, well, we could enter the market. We could see this is kind of yield curve control. We could see ourselves entering the market to buy some of these in the future. And so they're, look, they're giving us clues. They're giving us clues, Chris. It's coming. Okay. Yeah. When, what form, how much, all to be debated. But back to the chart that I showed at the beginning of the show, they've got to grow the money base or the whole thing collapses. It just doesn't work mathematically otherwise. And
Yep.
so again, very few things in investment are high probability, super high probability. But in my view, monetary debasement in a system set up the way we've got it is. There is an alternative, by the way. I should point this out. What's the risk? How am I wrong? I'm wrong, and you'll laugh at this. Everyone does when I tell them this. But people look at investing in my fund, and I say, "Hey, I got to tell you I'll tell you the devil's advocate bear case. The bear case is government gets incredibly responsible. You know what? We're not going to be an empire anymore. We're going to close half of these bases. We're going to means test Social Security. We're going to means test Medicare. We're going to chop your Medicare benefits. We're going to raise the retirement age. We're going to cut spending across the board in the federal government, and we're going to balance the budget." Okay, if that happens, if all of it, which I think should happen and would be a great course for this country, but if all of those things were to happen, what I'm talking about won't work. My thesis will be badly damaged. But generally, when I outline that as a possibility, the response I get is kind of, raucous laughter. I mean, do you really think there's any chance the government's going to do that? I mean, it's just not looking good, right? So
yeah. Well, so I have a very exciting announcement here, which is we're just about to announce today. We have a webinar series that we're producing at Peak Prosperity, and it's about it's a 3-part series. First, we explore why are they doing this? Like who's in charge here? Like is it the WEF, the Davos crowd, Soros and his billionaire pals, and Gates and all that? But the why, right? And to do that really effectively, we're going to red team, blue team this. Lawrence, you're going to love this. So I'm going to play the role of the WEF. And we also have Brett Weinstein, we got Peter St. Ange, we got Ed Dowd. And so
those
2 of us are taking red team and 2 are taking blue team. And we are just going to fully explore like why they're doing this. I think I understand why. They're the Great Reset. Like once you understand the actual debt to income chart, you just, again, it's pretty obvious. This thing has to be reset. But what does that look like? And I just think people need to get their minds around the idea that when resets like this have to come along, and they do from time to time, the power elites never want them to be the ones to take the losses. They want you to be the one. So that's the game, right? And then part 2 is like, well, what are the tactics they're using and strategies to get what they want? And it's easy. They're using 5th generational warfare. They're using divide and conquer. They're getting people all spun up with their media pals around gender issues and other completely meaningless but very engaging.
Well, they're gaslighting us massively.
Gaslighting us, all of that stuff, right? And then number 3 is well, then what do you do about that? And how do you protect yourself? Because I think people need to know this does get dark before it gets better. There's really no chance I can see at this point, short of that fantasy scenario you said where the government
gets responsible
out and flies, right? It's possible, but not likely. So we got to play the odds here. I think the odds say, we're going to carry on this path until something really, really breaks, and somehow we get rid of these cretins and we get responsible people, those Midwestern and Southern bankers you were mentioning. Until we can get that done, I think we have to be individually ready. So I just wanted to announce that because I'm super excited.
I'm happy to participate, and I'm happy to, it'll be fun to watch that because I think it needs to be done. I mean, and the reset, there's a way out of all this, and I do believe. I mean, I've got kids, and I'm optimistic. I'm not, people say, "Hey, you're a doomer," and I'm not a doomer. I'm this is like being a weatherman. I can see that there's a big hurricane coming, and I've got the tools to forecast it. I'm not going to sit here and tell you, hey, the weather's going to be great, when you got this hurricane coming. But guess what? The hurricane will pass. We will get this whole thing fixed. We will get it reset. And I think if we go back to a sound money standard, history has shown every time countries did have these kind of problems and they reset it in the right way, things got enormously better, better. So there's an optimistic outcome here, Chris, but there's probably, in my view, a 5 to 10 year window of storm. Hopefully on the shorter end of that. The faster they figure it out and fix it, the shorter it could be. But as our political class is not exactly the smartest group in the world. So
no, and I feel it's my sacred duty and yours too, and everybody. Like, listen, if we don't man up, because we're a couple men here, if we don't man up or woman up, if there are women listening, if we don't get this right and we let them just sort of do what they do, they're going to screw the pooch really bad. And I'm worried, Lawrence, they're going to get us into a war with China thinking, oh, well, wars are roughly stimulative. Like, no, not when there's hypersonic missiles involved and you're up against a foe that could actually shoot back. that's a totally different character from what we've been up to for the past.
Completely agree. I mean, good people have got to stand up and advocate for doing the right things. I mean, it's fourth turnings have shown that. Do you know what I mean? If you're not, I mean, it's going to be tough. But then that's why I do what I do, because I care about my kids, my someday grandkids. I hope so.
Yep.
Yeah.
Yeah. No. If you want to leave behind a world worth inheriting, now's the time, because
yeah, exactly.
Yeah. Yeah. So with that, well, thank you so much for your time today. We got it. We're going to do this more frequently. That was a great
I'm happy to do it
conversation.
anytime, Chris. I always enjoy talking to you. You're a great host. So,
Well, great. Thank you, Lawrence. Where do people find you and follow
yeah.
you?
So
And,
as you know, I'm a big mouth on Twitter. I generally just rant and rave against the central banks because I think they've really ruined our world. Just my name, Lawrence Lepard, at Lawrence Lepard. It's easy to find. A lot of fakes. Make sure you get the real one. I've got 150,000 followers. You go to my website, www.ema2.com. That has the newsletters I was talking about. They're free. They just talk about macro events. Little shameless plug. I do run a fund because of the SEC rules. The minimum's 100K per account. We don't always have openings. We do have some now. Some people have given up on the gold thesis, so we got a few openings. So if you want to join the fund, you can reach out and I'll tell you about that.
well, fantastic. And that's really great. And if anybody wants to find out more about the webinar that's coming up, of course, go to peak.prosperity.com. We have all the events announced there. And if you want your money managed more effectively and maybe the EMA is not quite the right fit, remember Peak Financial Investing. We got people who can speak this language, talk to you about these things, and not gaslight you. You deserve to have your money managed by somebody who shares your concerns and sees the world the same way. So with that, Lawrence, thank you so much.
Oh, thank you, Chris.
Until next time.
Okay.